Chris, for having me on again, especially after the issues with sound, etc. last week. I was scared I was going to get dumped, but luckily we're back again. So thanks very much. Hello everyone. Happy fireworks night. My name's Sam Norris, and I own Grand Union Finance. As Chris has just sort of given me a very brief introduction there, and we are a specialist brokerage that deals primarily with investors and developers. Looking after all types of finance, from mortgages to bridging development finance, commercial mortgages, and even dabble in the odd business loan every now and again as well. So there's all my contact details. If you've got any questions, I will do a bit of a Q&A at the end, but if you don't really feel like asking them in front of everyone, which I can fully understand, then feel free to reach out in any way that you prefer. So just running through a quick little agenda for you today. I'm going to do a bit of a recap on lockdown 1 so that we can talk about how that's going to be different from lockdown 2. After that, I'm going to talk a little bit about commercial mortgages, which I don't do very often, but I think it's quite important given the current climate. And then we'll finish things off with a quick Q&A if there's time at the end. And obviously I'll be led by Chris on that. So let's kick things off with lockdown 1. What happened during lockdown 1 that caused all the turmoil in the mortgage market? Number one, the property market closed. For mortgages, that's quite annoying. So effectively, there was obviously a massive knee-jerk kind of reaction to the uncertainty of the market closing and lockdown happening, that caused many changes, most of which were negative in our lovely mortgage market. We saw applications that were halfway through being declined all of a sudden, changes widespread to products, different products being pulled. I remember having a minor heart attack when I saw that Foundation remove their serviced accommodation product within about 24 hours of lockdown happening because I just knew that was going to cause a massive cascade of that type of lending. And given what happened, Chris will know this more than most, given his expertise in this sector, we're not quite back to where we were, and that's all from the initial lockdown. As I said, lenders stopped or paused applications, and some lenders were forced to pull out of the market completely. So we were pretty much in complete disarray. Pretty much everyone had to learn to work from home. These Zoom calls became pretty normal, and lenders, most of which had never even considered the idea of moving their workforce out of the office, suddenly were forced to do so. And this obviously caused a massive disruption to their daily way of life. And of course, one of the big problems that we faced was that valuations stopped. Valuers could no longer enter people's homes to do surveys, which, as you can imagine, caused a massive bottleneck halfway through a lot of applications. And there was only really a handful of lenders that were geared up to being able to do all of their valuations online. Most lenders had to cease new applications until they pulled the right technology together in order to make this work. As I said, massive bottlenecks created. And in fact, here's a lovely stat for you. At one stage, there was £82 billion worth of mortgage transactions that were on hold. So yeah, gives you a bit of an idea of how actually potentially catastrophic this could have been, which actually brings onto the next slide in terms of talking about lockdown 2, all the more amazing, really. Now, for whatever reason, my animations haven't worked on this one, so you'll just have to read them all at the same time. But now, if we go through practically all of the things that happened during the first lockdown that potentially could have happened again, we can see actually how this second lockdown should have nowhere near the negative impact on our mortgage market that the first lockdown did. So starting off with working from home, we're used to it. Lenders are used to it. Even lenders that I've seen that have brought certain parts of their workforce back into the office, following a lot of them on LinkedIn and things like that. They're constantly sharing pictures of them all socially distancing and all this sort of stuff. If they want to send all those people home, everyone's ready for it. All those structures are in place, which means that there really shouldn't be any disruption. I don't envisage any lenders pulling out of the market or taking products off the market purely on the basis that they've got disruption to their workforce. We're all ready for it at the moment, which is really, really good. Transaction numbers are as high as they've been in many, many years, if not ever. And of course, we've seen record house prices. Now, you might say, well, what's that got to do with mortgages? Well, it gives the lenders confidence in our market. That's what's so important about this. And lenders are hugely busy. As a result of that, their confidence is high. They're not worried. They're not pulling changing their criteria massively. They're not stopping from the flexible ways in which they can organise finance, and most of all, they're not pulling out the market completely, and they're not declining applications halfway through on the whole, which is great. It means that we can continue to, we're not going to see that bottleneck that we had before, which is going to cause people problems in terms of completing their purchases or refinancing, whatever it is. We are seeing that transactions are steadily moving through. Now, the fact that lenders are busy actually is a really, really important point, because a lot of people have seen that there have been some criteria changes. I mentioned in last month's meeting that Barclays pulled their 75% loan to value products. They're back now, but I remember, at the time there was people asking me, oh, does this mean that Barclays and other lenders that are similar envisaging, a big drop in the market? I said, absolutely not. They're doing it because they're just too busy to handle the kind of numbers of applications that they're receiving. If you think a lender like Barclays, they're probably one of the biggest banks in the country, if not the biggest bank in the country, maybe apart from HSBC. And so the fact that they are such a large organization, they are going to get a huge market share of new applications. They just physically couldn't deal with it at that period of time. And so they thought, what the hell? Let's just get rid of our 75% products. Let's just do 60% mortgages. Low risk for us, and we're still getting money out the door, as much money as we need to get out the door. And so that's what lenders are doing. They're not any negative product changes that you're seeing at the moment is not really down to lenders being uncomfortable with where the market's heading. From all the conversations I'm having, it's purely down to capacity. So for us as consumers, we shouldn't be too concerned about the future, given that the market is so buoyant. As I said before, the market is still open. It hasn't closed. The government has specifically stated that the property market will be remaining open in its entirety throughout lockdown. Estate agents and valuers are still allowed to conduct viewings and surveys. They're allowed to enter people's homes as long as they conform to the right safety protocols. And that means that we shouldn't, again, I keep using this word bottleneck, but we shouldn't see that problem arise again. Transaction numbers shouldn't fall too much. I do envisage that they're going to fall a little bit, and purely, I think, and this is just pure opinion at this point, I think that it's just mainly going to be some home movers that are feeling a bit uneasy about doing viewings, may not wish to do so, and may just wait until next year potentially to do that. But I certainly think that our sector of the market, the investor, the buy-to-let side, which makes up about a quarter of all transactions, shouldn't change. So on the whole, I don't really envisage transaction numbers falling too greatly. Flexibility. So in terms of both mortgages and short-term finance, so bridging, development finance, we've got a really good sample of products covering the market. As I said earlier, service accommodation style products are coming back. We do have lenders that are doing them. So that part of the market is covered. We've got lenders doing long leases. So the sort of social housing model is covered, although lenders like Alban aren't lending on HMOs, but they're just one of a number of lenders that we can go to for that type of lending. Bridging and development in terms of various different parts of the market, whether it's for those that don't have any experience, for whether it's ground up developments, whether it's refurbishments, we have lenders that are covering it. Bridging is back up to 75%. Development finance is up to 75% loan to GDV, if you really want to stretch it that far. I haven't actually come across a development deal or a development appraisal yet that requires 75% GDV to make it work. But it is there and it is available, which just means that across the board, although the number of products is not as high as pre-lockdown, we still have all the various aspects covered. And I think that's a really, really important thing to acknowledge. Now, this is the big one for me. We have more money in our market to lend at the moment that we ever have, ever. We actually have trillions sitting there waiting to be lent out. And lenders, to show just how much they do want to lend, even when they are at capacity. We've got lenders at the moment that are taking 20 days to view a new application, but that's not stopping them from trying to advertise their rates, to push the products that they've got. It's because they're all desperate to get this money out of the door, because if that money is sitting there in their account, they are losing money on it, because they're still potentially paying a funding line for the use of that cash. They're desperate to get it out the door, and they're doing everything they possibly can to improve their service standards. They're moving people around within their organization, from underwriting, from sales to underwriting. I've actually got a friend of mine who's a business development manager, and he's just been trained to be a temporary underwriter for the next 2 months, which I won't mention some of the words that he used when he was told that, when he said that to me. But I said to him, look, it's another string to your bow, but it just highlights what lenders are willing to do in order to try their very, very best to maintain the high service standards that a lot of time their borrowers have been used to, and us as brokers have been used to. So there's just loads and loads and loads to be positive about. I hate all the scaremongering that's in the news, so I take it as my responsibility to try and spread a bit of positivity. So good news, we're open for business, and so is the market. So that's my main message. However, let's talk about a bit of negativity. At the moment, we can't go a whole presentation without some negativity. It's not necessarily negativity in its entirety. I think what this is more of a warning as to what's going on in the commercial sector. It's not something I've really touched upon too much over the course of these presentations, but I'm wary of that, and so I wanted to talk a little bit about what's going on in the commercial sector. Now, the recovery that the commercial market is making is nowhere near as strong as the residential market. The number of products and the type of products and the flexibility of products is way behind where it was pre-lockdown 1, unfortunately. Now, this makes a lot of sense. Probably the two biggest sectors in property that have been hit over this point is certainly retail. You might want to chuck hospitality in, but I'll probably chuck those in together in terms of the type of units that you would use. A cafe can be used as a retail unit and vice versa. So in terms of the unit itself, we'll lump that in together. And of course, the office sector as well. And one thing that a lot of people have been talking about recently is the change of the dynamic of the office environment, with hot desking and working from home becoming a normal thing. Will this sector change completely? As a result, lending on these types of assets is down. There's no skirting about that issue. A lot of lenders have pulled out of it, and those that haven't have increased rates and changed criteria. When it comes to things like length of lease or borrower experience and that sort of thing, or even the type of tenant that you've got in. I stole a bit of terminology for a talk that I did last year, which I stole from a client of mine, which was called an Amazon-proof business. And basically, lenders are jumping on this, and they're looking at the type of business that you're potentially going to have in there and thinking, could this business go online? And if it could, then they're worried that, number one, they may go out of business because Amazon will win, or they go online themselves and realize that there's no need to actually have a shop. And so the lengths of the tenancies on these tend to be a bit shorter. So those two sectors in particular have been massively hit. And of course, as I said in point 3 there, commercial mortgage lenders just have low confidence in that sector of the market. Now, here is a big one, and I didn't actually realize this until about 2 months ago. We were trying to place an office purchase, and we went to the usual suspects that are going to give us the cheapest rates, and I was completely amazed that the likes of Hampshire Trust Bank and Interbay, which are two lenders in particular that are some of our go-tos, they weren't even lending on commercial property at all. It literally says in their literature at the moment that we're commercial lenders, not lending on commercial property. That's unheard of. I've been doing this for 13 years, and I've never once seen a commercial lender not lending on commercial property. So I think that gives you a real insight into how low confidence really is. And what they're sort of doing, how they're still lending, is they're really pushing their kind of mixed use property products, but they're still only taking into account, say, if we're looking at rental calculations to work out potential loan amount. Even when it's a mixed-use property, they're still only taking the income that's generated from the residential aspect to work out their loan sizes, which just makes life a little bit more complicated, to be honest with you. So the other big one as well that we've discovered is, we do a lot of HMO mortgages. It's probably one of our biggest in terms of volume. That's really where we do quite a large proportion of our transactions, and particularly in the sort of sui generis classification end of the market, 7 rooms or more, borrowers trying to get commercial valuations, so they're based on the income rather than the bricks and mortar valuation of the property, and it's a great way when you're growing your portfolio to borrow as much as you can to keep building and keep leveraging and keep building. However, lots and lots of lenders are even shying away from these types of valuations at the moment, even when they are sui generis classification. As I said before, we've had a rejection in the last month from Shawbrook saying that they won't do that, which was quite surprising. I think that had something to do with with where the property was, but they still rejected it. We've had rejections from Hampshire Trust Bank on that, and certainly Interbay as well, and even Cambridge and Counties, who again are one of a sort of big go-to lender on that. And we've even had the likes of Lloyds say no to a couple of these as well. So it's not sort of widespread across the board criteria. I just think lenders are being a little bit more OTT on what properties they will and will not look at these commercial valuations on. However, to end on a bit of good news, every single lender that I have spoken to who's currently not lending on commercial property or are shying away from commercial valuations, all of them have said this is not forever. This isn't a full-time thing. They're working their way into getting back into those markets. However, I've literally had conversations this week. Once lockdown 2 was announced, most of them did say that was going to be on the back burner until 2021 now. So I expect the commercial criteria pretty much across the board to remain pretty inflexible for the next couple of months. And it's really not going to be until, I reckon, midway through Q1 next year that we're going to start seeing wholesale changes. Excuse me. So reason to be optimistic for the future, but things are a bit tight at the moment. So where this is going to be quite important, I think, is there's lots and lots of people out there at the moment that are looking at the sort of commercial to residential type development deals. Lenders are still, even though they know the end product is going to be residential, some of them are struggling a little bit on this side, development finance wise, for this. So it's something just to be a bit wary of if this is something that you're getting into. But that's me done for now. Chris, have we got time for any questions?
Yeah, we have. Thanks for that. Sam, I always appreciate the work you put into presenting every month, so thank you very much for that.
No problem.
I'll just open up. So if you want to ask a question, you can just unmute yourself and you can ask a question of young Sam. And your sound was so much better, Sam. Thank you.
I've got the top level microphone. My £40 microphone is back.
Sam, worth every penny.
Yeah, well, I do need to get a little cover for it. It's a bit echoey, I've found. So I'm just upgrading as I go.
Yeah. I've got a couple of questions, Sam.
Cool.
One was about the commercial lenders not coming back in the market until 2021. So it's about what is it they're looking for? So are they looking for like a resolution to the borrower? So are they just waiting for a bit more data? Are they waiting for sort of employment figures, that type of thing? So it's just struck me that they can wait until 2021, but I just wondered, what are they actually waiting for them to start lending again?
Yeah, I think a lot of it is down to that many of them were looking to start lending again pretty shortly. But with this second lockdown happening, and particularly the fact that pretty much, retail and hospitality has now been shut down again, I think it's just put back those plans. All the lenders have got plans to get back into this market. It's where they sit. But one thing I've found with commercial lenders is when it comes to criteria and products, it takes them a lot longer to get comfortable with certain types of products than a residential lender would, because I just think it's a little bit more specialist in terms of it. So I think you're right. I think they're waiting for more data. I think a lot of them are skeptical as to the future of the high street. So that real retail market, when that's ever going to come back, I don't know. And actually, I think that when a lot of these lenders come back in, I think still a lot of them will exclude retail to start with, potentially even hospitality to a degree as well. I think that most of them would be happy to come back in for sort of, warehouses and that sort of thing, because obviously the government is still supporting manufacturing and construction and things like that. And so I think that sector of the market is relatively well protected. So from a lending perspective, you'd have more confidence in those types of that sector and those types of properties. It's just those the sort of the office sector, and then even worse, the retail and hospitality, that they've got to get their confidence back before they're going to be happy to lend on these properties, because these are long time loans. Remember, these are 15, 20-year loans sometimes. They need to have the confidence before they issue a loan for that period of time.
Yeah. But so that sort of makes sense. I think for me, moving on to the HMO side of commercial lending, it's always been a bit specialist for me and quite tricky. So you can see why there'd be a reluctance. So in terms of risk, you're going to be much easier to lend on a bricks and mortar basis rather than on an income basis. So for me, if I was a lender and wanting to reduce risk, that sort of makes sense to me, I must admit.
Well, do you know what, it's if you think about it from the point of view of everyone's waiting for this dip. I'm using a different terminology. I'm going to call it a correction, because the way I see it is that if a market generally moves like that, we've seen this happen recently, and so it will just do that to get back onto the natural course. So everyone's waiting for that to happen, and what I think lenders are skeptical about is they're always thinking about what's the worst thing that could happen, and if they need to if they need to repossess a property, what's going to be the situation. Now, if we see a dip that may stagnate over the next 2 years potentially, I'm hoping that won't be the case, but once this dip does happen, and I'm predicting it's going to be Q2 next year for obvious reasons, what lenders are worried about is suddenly, from a bricks and mortar valuation point of view, some of these borrowers might actually end up being in negative equity if they borrow on a yield-based valuation, which obviously usually they do that because it exceeds the bricks and mortar valuation. And I think that's what they're worried about. Either that, or then the loan to value, when you place it against the bricks and mortar, is so high that if there is a real sort of negative change in the commercial market in terms of the flexibility of loan to values, and suddenly the norm in the market is 65%, and there's a spate of people that are borrowed up to 85 when you base the loan against the actual bricks and mortar valuation because they've done yield-based valuations, that's where suddenly these risk assessments that these commercial lenders are doing are going into overdrive. And that's the basic reason why they're pulling out of this part of the market.
Because last point was, in terms of managing risk, one of the ways to do it is to increase the interest rate. So are you seeing any of that?
A little bit, but not widespread. I think that I don't think rates are going to be coming down, but I don't really think they're going to be going up too much either, to be honest with you. I think we're naturally where we should be. Now, I think the thing that I'm a little bit concerned about, not concerned, but we have to remember, again, going back to that kind of correction terminology, we're also at record lows in terms of the Bank of England base rate. And realistically, the natural point for where a Bank of England base rate should be is probably around 3 to 5%. Now, if we keep the margins with our lending that we currently have, and in 10 years' time, we're back up to 3 to 5%, just think where your normal residential mortgage rates are going to be. We could be looking at 5.5 to 7% as a normal mortgage rate. And I think that's what everyone needs to be a little bit wary of when you're over leveraging yourself, or you're leveraging yourself relatively high. Always make sure that you're stress testing your interest rate as high as you possibly feel comfortable with. I mean, when I'm analysing deals with clients, I try and push them up to 5.5%. Yeah. Because I say to them, look, if you've got a deal that works at 5.5%, that's a steal. So to get it, and yeah, the way that I'd be looking at that is think about what could be in 5 to 10 years time, basically. And yeah, that's where I think people should be stress testing, basically.
Yeah. I think, I mean, we're so used to really low rates that once at some point, actually, they will start to go up.
It's got to at some point.
Yeah, I agree. Sam, that was fantastic as always. You're a star man.
No problem.
You're like
Thank you.
The star of lending. You are.
Well, I'm glad that I've come to a finishing point there, because I can hear you. Probably can't hear it because my mic isn't that good, but I'm pretty certain that my cats are having the biggest fight of their lives next door. So I feel as though I might need to change this hoodie to a sort of a striped black and white top to do a bit of refereeing. But
put your helmet on.
Yeah, I know, they're vicious.
Okay, thanks.
No problem.
Thanks a lot, Sam. I think we might have a question from Richard. Shall I unmute you, Richard?
Yes, Sam, I just wanted to ask, in all your discussions with lenders, have you heard any whiff of more bounce back loans?
In terms of what
for businesses, yeah,
banks offering
mortgages,
them. Yeah. So it's been extended. The government have said that they are going to extend the time frame. However, one thing that I've noticed is that lenders are being a little bit more cautious with bounce back loans. So I'll give you an example. A friend of mine about 3 weeks ago tried to get a bounce back loan with Metro. He in his application he put that his projection would be 205,000. And knowing what he does, I think it's probably possible, but unlikely. And he was picked up on it. He had the email that said you've been accepted, you got 50 grand. But it then actually transpired that they'd gone back into underwriting and they wanted to see proof of it. They wanted a breakdown. They actually asked him, how are you going to achieve this amount? And so I think that actually there has been a little bit of a change. I don't think it's a bad thing, to be honest with you. The ability, the government have put more money into it. They've extended it. They're allowing lenders to do it for a longer period of time. But actually what they're doing is lenders themselves are trying to stop potentially, fraudulent applications. Because if you think about it, a bounce back loan is pretty similar to a self-cert mortgage about 15 years ago. All you needed to do was write Mickey Mouse and then sign it at the bottom, and as much money as you wanted was yours. A job as a mortgage broker would have been tremendously easy back then. It's a shame that I came in 2007, really. But that's how that market is at the moment. There is a feeling for me, though, that actually I think transaction numbers are tapering off a little bit, because I think those that have wanted them and needed them have kind of gone for them by now. And certainly I spoke to my business bank manager also at Metro, funnily enough, last week, and I asked him about it. And he says, yeah, they're definitely getting fewer applications than they were 2 months ago, albeit that they're still quite high in number.
That was Andrew.
Yep.
Yeah. Okay, thank you.
No problem.
So good question, Richard, and doesn't look like you're going to be getting any more bounce back loans anytime soon. So thanks a lot, Sam. I'll move on now. If we can move to our next presenter, who's Julie Ford.